The bankruptcy law changed in 2005, didn't it? We talked about it. It's called the Bankruptcy Abuse Prevention and Consumer Protection Act, BAPCPA. What's the number one thing that BAPCPA did? What's the biggest change that we saw in BAPCPA that we're going to talk about tonight?
It instituted the means test.
The means test. Thank you, Michael. The means test. What does that? Oh my goodness, it's a long mathematical formula that nobody seems to understand. But you're going to understand it before we're through. Now, this doesn't mean that you have to specifically know how to fill out every aspect of a means test for this class. But you certainly need to know about the means test and at least the basics of the means test, or you won't be able to counsel your debtor on what his choices are. So let's talk about the means test for a minute. What are some of the things we need to know for the means test?
What the income is, income.
We have to know income. What else do we need to know?
Household size.
Household size. What else?
Family.
The family. How many people are in the family? Expenses.
Possible retirement.
I'm sorry?
Possible retirement benefits.
Retirement benefits, because if they've withdrawn them, that's income.
Correct. Or if they received a loan on their retirement benefits.
In other words, it's income from all sources. It gets so tricky that they even want us to write down money that we're getting from other people. If your parents give you $200 every month on a regular basis, you have to put that down. But when we talk about, now, some people say, wait a minute, household size and family, isn't that the same thing? No, it's not. You could have a roommate. That's not family, but that's your household size. And so how much is your roommate contributing towards your expenses? That's included. So let's look at the structure of the means test for a minute, and it'll all become clear as to what they're trying to do. Let's look at that means test that you've got in your book right there, and let's break it down sort of in an outline form so you can understand how and what the different categories are. What's the first thing on the means test we're trying to calculate? What's it called?
Wages and monthly income.
Current monthly income. Now that's an important term that's used in the cases and all throughout the code. It's called the CMI, current monthly income. And how do they have us calculate the current monthly income? How current is it? It is the last 6 calendar months, not the month you're here in my office. So it isn't current, it's what it was. And sometimes that can be very deceiving. You could have been making good money, just lost your job, come to see me for a bankruptcy, and you would think you qualify, but you were making $100,000 a year over the last 6 months, and you don't, unless we show some exceptions in the case. So, but literally the current monthly income, you have to go back and look at exactly what they made during the last 6 calendar months. And not only the debtor, but if he or she is married, the spouse as well, even if the spouse is not filing. So if you make 0 and your spouse makes $500,000 a year, you're not going to be filing bankruptcy. Doesn't seem fair, does it? But that's the means test. It literally is all family income in your household. One of the first things you look at is, are you married or are you not married? And then if you are married but separated, there's a box you can check that says, by checking this box, you declare under penalty of perjury that you and your spouse are legally separated, and not just for the purpose of defeating this test. So you have to literally be out of the house and separated. If you are, then you don't have to count the spouse's income. But if you're married and still living in the same house, boom, there you are. Another complicating factor is what if you are married, living in two households? We've had that situation. The guy's moved here, he's starting to work, he's living in an apartment. And the wife is still back home trying to sell the house. What do? Doesn't work, does it? All right. Household size family. Let's talk about that family thing for a minute. When we talk about household size, how is that determined? What is the test to determine whether or not that person lives in your house and should be included in this test? Any ideas?
Whether or not they're contributing to the household expenses.
Exactly correct. That is called the economic unit. One of the others is heads on beds. The U.S. Trustee's Office likes to count heads on beds. They're saying if they sleep in your house, that's part of your household size, and we have to count them. But the majority of the courts are holding economic unit theory, whether they are pooling their money and paying expenses or whether they're contributing towards the household expenses of the family or the household. Why do we need to know what that household size is? Look over at question 13. Calculate the median family income that applies to you. Fill in the state in which you live and fill in the number of people in your household. What if you've got a child that only comes every weekend? What if you and your spouse that you're divorced from split weeks? How do you calculate those things? The code doesn't tell us. So that's how all the cases get developed over this, trying to figure out how you do that. But when you look at the little cheat sheet I handed out to you, here's mine. You've got across the top the allowable median income, and you see that a family of one in Alabama, the average median income is $43,476. These numbers change every 6 months. 2, $52,970, 3, $60,367, so forth and so on. So once we determine what the household size is, then we know how much income they're going to be allowed under test number 1. Here's another one. What if you've just graduated from college and you've moved in with your grandparents until you can get settled into an apartment? Do you count them as part of your household size, and so you now get 3 people? No, because they're not part of the economic unit. What if you're just living there for free? They're still not part of the economic unit. You're just staying there. It's temporary. It's not a permanent situation. But anyway, under test number 1, we're going to go down through here and we're going to count up all of the different incomes. And after we get them from all these sources, we're going to come up with the current monthly income, the CMI. We're going to compare it to this chart. And if you're above it, you're an above median income debtor. If you're below it, you're a below median income debtor. And that is important. In Chapter 7, that's test number 1. If you're above median income debtor, if you don't pass the second part of this test, it's more complicated, you're not going to be allowed to file a Chapter 7. But in a Chapter 13, if you're above median income debtor, we're going to come through the rest of this test, and whatever's left over is how much you're going to have to pay in the case. And above median income debtors have to pay it for 5 years, and below median income debtors can pay it for just 3. So that above and below median income is important. So are you above or below? Look at some of the things that get counted as gross income. What are they? And by the way, it's gross income. It's not net. It's not your take-home. This is without any deductions. It's your gross income from all sources. Alimony and maintenance payments, regular contributions from an unmarried partner, members of your household, your dependents, parents, roommates, regular contributions from a spouse, net income from operating a business, rental property, interest, dividends, royalties, unemployment compensation, pension or retirement income, and then income from all other sources, the catch-all. So as Kiera told us, if you've drawn, and this can really mess you up. I had one today. We had it all figured out, looked like he was going to qualify, and then I asked him the deadly question. Have you drawn any money out of a retirement account in the last 6 months? And they'd just taken $10,000 out. Uh-oh. We have to take all of the gross income for the last 6 calendar months, divide it by 6, and that goes into the current monthly income. On 10,000 divided by 6, that increased $1,666 a month. Oh, that blew them right out of the water. There was no way they could qualify. What do? Find out what month they drew it in and wait till that 6-month window is gone. If he drew it out in November, next month, it won't count. It'll be December, January, February, March, April, and May. And then he can file. So that's important to know how much they took out and when they took it out. After we've calculated the first part of this test, we now know what CMI, current monthly income, is. The second part of the test is where we calculate the disposable income, the DI. And that is broken down into 2 parts. Anybody know what the 2 parts are? Expenses. But there are 2 kinds of expenses. Anybody notice what they were? That's the tricky part of the test. Of this test, not my test. The tricky part of this test is you have the IRS standards. There are actually 3 parts of part 2. You have the IRS standards, which carries you through question number 24. 25 through 32 are the other necessary expenses. We call those the ONEs. And then from 33 to 37 are the debt payment expenses. So here's what you do. When you look at this little cheat sheet I've got, I just pulled this out of my desk because I don't remember these numbers. Notice that under IRS local standards, I have it broken down by county, and I have 2 numbers. Look at Shelby. For 1, you're allowed $961 for housing and $478 for utilities is what that means. Those are the IRS standards that come out of the IRS code. If you actually pay more than $961 for your house note, you'll get the higher amount later. You'll take the $961 right there, and then later under secured debt, you'll get the difference. Notice how it goes up depending on how many people are in the family size. Again, this is family now. So as far as your housing expense and your utilities, that's set by the Internal Revenue Service codes. And under transportation, it's 1 car, 2 cars. They'll only give you the deduction for up to 2 cars. And then we have the operating expense. If you have no car, 1 car, or 2 cars. Then you have the health costs for a person under 65 or a person over 65. And those are the IRS standards. Now we're going to come back and talk about those when we talk about the ransom case in just a minute. Look at question 25. At the end of those first 24, you add all of that up. Then you go over here to health insurance, disability insurance, and health savings account expenses. And they have to be other necessary expenses. If they're not necessary, if they're not reasonable, the court can reject them. But if you're being payroll deducted for those things, you can take those off. Or if you actually pay them yourself, you can take them off. education expenses for dependent children under the age of 18, but you're limited to $156.25 per child per month. So private education doesn't really work very well. Continuing charitable contributions. When you look in the code, it limits you to 15%. And then additional expense deductions you can put down. And then at the end, 33 through 37 are debt payments. Here's where we'll actually subtract the difference, the rest of your house note, and the difference between what they allow on a car and what your car payment really is. And by the way, it's not your real car payment. They take the total amount you owe and divide it by 60 months, and that's the number you're allowed. Or the $485, whichever is higher. And then are there any other debts? If he has a furniture debt, if he has a TV debt, if he has any other secured debt, we get to put it down there, take the total amount owed, divide it by 60 months, and put it there and get that as a deduction. Back under the reasonable expenses in the first 24, we get to subtract his actual taxes that he pays. So if they've taken $10,000 out of a 401k, how much was withheld for taxes? We can take that too, divided by 6 months. So that's sort of the breakdown of how this means test works. Remember, you don't have to know exactly how to figure it out, but you certainly want to know how it works. So if somebody asks you, and sometimes if you're a creditor, you will find all kinds of mistakes in these on a petition. So it's very good to know whether you're a creditor's attorney or a debtor's attorney, how it works. The next thing we want to do is to focus on this Supreme Court case, ransom. Yes, ma'am, question.
This is not just your worksheet, this is
That,
file.
I'm sorry?
Is this what you file, or is this your worksheet?
No, you actually file that means test with the copy of the petition. And you have to furnish the last 60 days of pay stubs, and you have to furnish your last year's tax return to the court to back it all up. If somebody doesn't have the pay stubs, you can do an affidavit. If they don't have a tax return, you can do an affidavit if it hadn't been filed, for instance, if there's been an extension. But if they don't have a tax return, they've only got 20 days after they file the case to get it, so you don't want to file it without the tax return. And we're lucky because here in Birmingham you can go over to the IRS office and get a transcript. If you don't live here, you got to phone in and get it, and it takes 10 days. The reason we use this ransom case, though, as an important case is because until the ransom case was decided, there was a big controversy. And the controversy was the car debt. Whether or not, if we had a car that we owed $10,000 on, we got to subtract $485 a month for it. If we had a car that we owed $100 on, we got to subtract $485 a month for it. If we had a car that we owed no money on, we got to subtract $485 for it, but certain jurisdictions didn't like that, and that case went all the way up to the Supreme Court, and that's this ransom case. Somebody tell me about it. What did it tell us? Michael.
Well, basically, in the ransom case, ransom filed for Chapter 13 bankruptcy, and he lists FIA card services as a creditor, but he also listed as an asset the car, but the car didn't have a note on it. He actually owned the car.
Didn't owe any money on it at all.
And so one of the things that he did in determining his expenses was that he claimed the car ownership deduction, and that deduction was $471, and he also claimed the $388 deduction for car operating expenses. And so basically, his application or petition for bankruptcy ultimately was denied because he claimed the car ownership deduction. And so what happened, FIA Car Services, they filed
An appeal.
An appeal
Right.
to his petition, saying that he listed the deduction when he didn't have a note or a loan on the vehicle, and that was improper. And so the court sided with FIA Car Services and basically said that if you don't have a loan on the car, you can't claim the car ownership deduction. And so he fought, and ultimately, the Supreme Court came back and said that if you don't have a loan on the car, you can't claim that deduction. And that the only deduction that he could have claimed was the $388 deduction for car operating expenses. And what in essence happens is that when he claimed the car ownership deduction, it basically reduced the amount that he could pay.
That he had to pay Chapter 13.
Creditors. And so FIA basically said that he's over the 5-year time span that he could pay back, he's almost reducing his allowable or disposable income by almost $30,000.
Well, there are two ways that this made a difference. And you've stated it perfectly, but there are two ways. In a Chapter 13, the means test tells us an outline, gives us a little border as to how much he has to pay in the Chapter 13 case. So that gave him less money so he could pay less. In a Chapter 7, it would have been the difference as to whether he even qualified or not for the Chapter 7. So it can make a difference in either 7 or 13. All of the other circuit courts had decided that you could take the $485, it's $485 now, back then it was $471, even if the car was paid for. The Ninth Circuit, California, had said, no, we can't. And this court affirmed them and reversed all of the other circuit courts that had said that you could take it. But let's look at the language of the statute that caused that dispute. I mean, it seems to be so obvious, doesn't it, until you really get into the language about it.
Right.
And Justice Kagan delivered the opinion of the court, and she had always thought Justice Scalia was her mentor, and she really was very, very fond of Justice Scalia. And Justice Scalia wrote the dissent in this opinion, and it's kind of interesting how softly he worded it. But anyway, they were big buddies, but one very liberal, one very conservative. Section 1325 says, for a debtor whose income is above the median for the state, the means test identifies which expenses qualify as amounts reasonably necessary to be expended. Page 3 of the opinion, the test supplants the pre-BAPSIPA practice of calculating debtors' reasonable expenses on a case-by-case basis. What we used to do before BAPSIPA is we would do the budget. Schedules I and J, and whatever it said, that's what we paid. But now Congress thought that was being abused and that certain judges would allow more expenses than others, so they set a test, a means test, and said, this is what we're going to go by. And it said, the debtor's monthly expenses shall be the debtor's applicable monthly expense amounts. When we turn over, let's see, to page 7 of the opinion, what makes an expense amount applicable in this sense is most naturally understood to be its correspondence to an individual debtor's financial circumstances. Rather than authorizing all debtors to take the deductions, Congress established a filter. A debtor may claim a deduction from a national or local standard table if, but only if, that deduction is appropriate for him. That's language the Supreme Court added. It doesn't really say that. It doesn't say if, but only if, but that's their interpretation of it. And a deduction is so appropriate only if the debtor has costs corresponding to the category covered by the table. That is, only if the debtor will incur that kind of expense during the life of the plan. Now, what we were arguing, and what the other circuits had held, was there is an ownership expense even to a car that's paid for. It's depreciating, and we're eventually going to have to buy another car. It's getting worse and worse and worse, and we're going to have operating expenses, but we also have a depreciation. The IRS lets you depreciate a car, so why shouldn't we be able to do it that way? That was the other side's argument. And wait till you hear Justice Scalia's dissent, and you'll see they both really make pretty good sense. Because Congress intended the means test To approximate the debtor's reasonable expenditures on essential items, the debtor should be required to qualify for the deduction by actually incurring the expense. That's Justice Kagan's logic to it. Makes perfect sense when you hear it that way. She actually went on to say that Congress created a brighter line test. And she also said, if a debtor's actual expenses exceed the amounts listed in the tables, the debtor may claim an allowance only for the amount in the table. They don't get the extras under that first section, under the IRS standards. Under other necessary expenses, we get to claim the actual amount. But under those first 24 questions, we're stuck with the amount Congress set. And what Justice Kagan said was, on page 16 of the opinion, Ransom first points out a troubling anomaly. Under our interpretation, debtors can time their bankruptcy filing to take place while they still have just a few car payments left. You may only owe $100, like I put up here, but you get the full expense. On the other hand, if you don't owe anything at all, you can't get the expense at all. This kind of oddity is the inevitable result of a standardized formula like the means test, even more under Ransom's reading than under ours. Such formulas are by their nature over and under-inclusive. In eliminating the case-by-case adjudication of above-median income debtors' expenses that we used to have before BAPSIPA, Congress chose to tolerate the occasional peculiarity that a brighter line test produces. Now, I thought it was interesting that Justice Kagan used that word instead of a bright line test. She called it a brighter line test, and she was talking about Congress. Kind of interesting. I don't know that Congress has necessarily been accused of being brighter. Let's look at Justice Scalia's dissent. When you look at the end of his dissent, let's listen to the opposite argument. The reality is to describe it in the court's own terms that occasional over-allowance or under-allowance is the inevitable result of this standardized formula. Congress chose to tolerate the occasional peculiarity that a brighter line test produces. Our job, it seems to me, is not to eliminate or reduce these oddities, but to give the formula Congress adopted its fairest meaning. In my judgment, the applicable monthly expense amounts for operating costs specified under the local standards are the amounts specified in those standards for either one car or two cars, whichever of those is applicable. Now, to go back, if you read the rest of the opinion, what he's saying is it all boiled down to the definition of one word, applicable. Did applicable mean that you had to have an expense, or was applicable meaning whether it was just one car or two? Isn't that crazy how a statutory formula can break itself down to the definition of one word, applicable? And it had to go through 5 years of litigation, go all the way up to the Supreme Court for us to hear what the word applicable really means. And then you've got a 5-3 decision where you've got part of the Supreme Court saying it means this and part of the Supreme Court saying it that, but it's the majority. So that's our ruling, and that's what we have to live with. Questions? You understand the means test? You certainly understand its importance and the fact that it's broken down into several parts. Let's review for a second. You need to know what CMI means, current monthly income. Every time your debtor comes in, you're going to have to know what his current monthly income is. You're going to have to know what his expenses are. You're going to have to know his household size, family size. And what you're essentially going to have to figure out before you get through filing any kind of case for him, you're going to have to know what his disposable income is.